Well, good day. So I'd like to spend some time talking about Chapter 10 as it relates to property and vehicle insurance. We'll spend a little bit more time within the property insurance section speaking to the insurance that's available to you as renters, since that will probably be more applicable to you upon your initial life after leaving the university. And then we'll move into the conversation around motor vehicle insurance and what you need to be on the lookout for. So when we talk about what we're trying to accomplish within Chapter 10, we've really got about 6 different learning objectives. The first one, we want to first need to have a conversation around what risk means, okay, and how we go about developing a risk management plan, okay, that incorporates insurance into that plan. Okay, so we have to start thinking about the different types of risk that exist, what risk is considered to be insurable risk versus what risk is not. We'll get into a discussion around the importance of property and liability insurance, why we even have these products at our disposal for purchase. We'll talk about the difference in insurance coverages, okay, because there's a lot of language, lingo, if you will, that goes into the insurance world that I want you to understand so that you're better educated when you're out there getting estimates for your own insurance. What type of insurance is available for homeowners and to renters, all right, because it is different between the two. All right, we're going to talk a little bit about what influences the premium costs, okay, because the insurance premiums are not all the same, okay, and we'll see that insurance costs can vary pretty significantly from one region of the country to another, as men versus women. The type of car that you own, is it a new car or a used car? What color of your car? All these things factor into the overall cost of the insurance premiums that you'll face. And then we'll go through the insurance coverage requirements for vehicles, which is very important. And then again, finally, we'll talk about the factors that affect the cost of vehicle insurance, just like we had the conversation around what affects the cost of homeowners and renters insurance. So the first conversation we have to have revolves around risk, right? What is risk? What types of risk exist? Okay, and what types of risk can we go about insuring against? Okay, so what is insurance to begin with? Right, well, at the 50,000 foot level, right, insurance is nothing more than the protection against a possible financial loss. Okay, it's very important there. Possible financial loss. Okay, and because it offers you a certain peace of mind. Okay, so you have the insurance company, okay, or the insurer, the person who is providing the policy. Okay, they are what we call risk sharers. Okay, they assume the financial responsibility for losses associated with the risk that is being insured. Okay, so the insurance company is the entity that is assuming the risk. And when people, you and me, or your parents, grandparents, when we purchase insurance policies, okay, the firm is assuming that risk, the insurance company is assuming that risk for a fee. They're not going to just do it for free. And we call that fee the premium. Right? And then we, as the policy holder, as long as we continue to pay that premium, then the insurer, the insurance company that sold us the policy, is obligated to fulfill the duties of the contract that we're continuing to pay the premium on. Okay, and we can pay these premiums annually, semi-annually, monthly, but it's cheaper and more cost-effective for us as the policy holder to pay them once a year. Okay, it's less transactional costs, on the part of the insurer, the insurance company, and oddly enough, surprisingly enough, they actually do pass along some of that savings to the policyholders in the form of a slightly lower premium if we're willing to pay annually. So what types of risk exist? Okay. Well, we're going to see where we can kind of break it down into pure risk and speculative risk here in a second. But we first need to talk about the three different types of risk. Okay. So we have, well, first of all, what is risk to begin with? Well, risk is very simply an uncertainty, okay, lack of predictability, if you will, such as the loss that a person or property covered by insurance faces. Okay. How much risk is associated with our homes here in the state of Maryland being swept away by a tornado compared to, say, if we were living in Iowa? Okay. Significantly lower risk. All right. So we have less uncertainty. Okay. That's going to happen. We have more certainty that it's not going to happen than we do uncertainty. Right? Whereas in Iowa, we have more certainty that we have more tornado risk than the other parts of the country. Okay. So risk is the uncertainty or the lack of predictability, okay, such as the loss that a person or property covered by insurance faces. Okay. And we have what are called perils. Okay, so a peril is the cause of the possible loss. Okay, so the tornado, the fire, the windstorm, the hurricane, okay, premature death, that is a peril. So the cause of the probable possible loss, right? And then we have what's called a hazard, right? And a hazard is something that increases the likelihood of a loss, okay? Not wearing your seatbelt, okay? Driving through a crime-ridden part of town, okay? Both of which increase the likelihood of a loss in the event that something were to happen, okay? So we have perils, which is the cause of the possible loss, and we have hazards, which are those things that increase the likelihood of a loss. Which leads us to the two different types of risk that exist. We have pure risk, okay, which is the most common type of risk, right? And we classify these as personal risks, property risks, and liability risks, okay? All of which have the possibility of financial loss. This is also what we call the insurable risk, okay? There's the chance of a loss and no chance of a gain, okay? If we suffer, okay, the consequences of the risk that we bought the insurance policy for, we only have one economic state that we find ourselves in, and that is a financial loss. We have no possibility of a financial gain if the policy kicks in. Okay? And we find that with pure risk that the nature and the financial cost of the losses can be predicted. Okay? Insurance companies have decades upon decades upon decades of data for all of the risks that probably exist out there within the market, with lots of examples that they can draw from to determine with relative accuracy how frequently those same incidents are going to occur into the future. Okay, so they can predict pretty well what portion of the risks that they insure and the losses that they have sitting on their balance sheet, potential losses that they have sitting on their balance sheet, when they're going to occur, how much those instances are going to cost them. Okay, so it's predictable. It's important that you understand that pure risk is predictable and insurable. On the other hand, we have speculative risk. Okay, and speculative risk is not insurable risk, because speculative risk implies that there could be a gain associated with taking risk. Okay, Maybe you found a stock within the market that you felt was going to double within the next year, but you wanted to buy some insurance in case it went the other way. All right. Anybody have an idea of what a quote parenthetical insurance policy might be for a stock that could fall in value? All right. We'll talk about that in the next couple of lectures, but it's an option. You could buy an option. All right. But that is not the type of insurance policy that we're referencing here. So speculative risk, meaning that there is a chance of either a loss or a gain. Okay. Starting a business, gambling, buying a high flying stock within the market, not insurable, okay, from an insurance company standpoint. Okay. There are other financial products that you can buy, okay, to hedge against possible losses, okay? But we're not going to be talking about those as it relates specifically to homeowner, renters, and vehicle insurance. Okay. So how do we go about managing this risk that exists out there? Well, we have to engage in a risk management strategy, okay? And an organized risk management strategy, not willy-nilly, okay? That's going to look to protect the assets that we've worked hard to obtain and the people who we love in our lives. Okay? So there's 4 different techniques for managing risk. Okay? The first one is fairly straightforward, risk avoidance. We just avoid it altogether. Okay? Instead of driving through the crime-ridden parts of town, we find a different route that's much safer, okay, with no risk associated with it. So, although I think that would be hard to find in Baltimore, but nonetheless, risk avoidance. We just avoid the risk altogether, okay? Smoking causes cancer, so we simply don't smoke, okay? We avoid that risk altogether. The second technique is risk reduction, okay? We still need to get to our job, okay? Our job happens to be located in a part of town that is high in crime, okay? But we can do certain things to reduce the level of risk associated with getting to our job. We lock our doors. We don't roll our windows down. We wear our seatbelts all the time, okay? We get our carry permit, all right? All things that we can do to reduce risk, right? In our homes, we have security systems that are installed. We have smoke alarms, carbon monoxide detectors. Okay? And then from a health and wellness standpoint, having a balanced diet and getting some exercise, which I have failed miserably at this semester and for the last 8 months, to be quite frank. Okay, all things that we can do to reduce risk in our personal lives. Right? The third technique is risk assumption, where we as individuals say, I am going to assume the risk that I'm looking at, and I'm going to take responsibility for the expenses of what happens in the event, okay, of a peril. Right? So we assume the risk. We call this self-insurance. Okay, many uber wealthy families self-insure because they have so much money that they can pretty much afford any cost associated with the damages that might result from the risks that exist. Okay. And then finally, the fourth technique, okay, is what we call risk shifting. Okay. And that's where we transfer the risk to somebody else, okay, AKA the insurance company that we were just referencing. Okay, we transfer the risk. Okay, and when we transfer the risk, okay, it comes with certain obligations on both parties' part. On the part of the policyholder, we pay that premium. Okay, and we're also on the hook for what's called a deductible. Okay, it's the amount of money, the first amount of money associated with a claim, okay, that comes out of our pocket as the policyholder. So if we have a $1,000 deductible, okay, on let's say a $20,000 personal articles insurance policy, and somebody breaks into our home and steals our jewelry, okay, personal articles, and the value of that jewelry, okay, that was stolen was estimated at $10,000. But we have a $1,000 deductible. It means that of that $10,000 that is involved in the theft, okay, of the personal articles policy, we owe the first 1,000 of that 10. Okay? And then the insurance policy will kick in and they will write us a check for the remaining $9,000. Okay? And then we can use that money to hopefully go out and repurchase the jewelry that was stolen. Okay, so the deductible is the set amount that you as the policyholder must pay per loss on that insurance policy. Okay. Before the insurance policy kicks in and writing you a check for the difference. So when we start thinking about how we go about planning for the insurance program, first thing I have to do is, again, just like we were talking about earlier in the semester with finances, we have to set our insurance goals. What are we trying to accomplish? Okay. What, with the personal articles policy, great example. Okay. What personal property do we have? Okay. That needs to be insured against theft or loss. Well, I've got a triathlon bike, all right, that is fairly expensive. I have a few other items within the house that are also relatively expensive. We have some jewelry. We have normal things, okay, that families have that have value. Okay? So when you set your insurance goals, right, you don't need to over-insure, but you also don't want to under-insure either, right? So you got to set your goals, right? And then we develop the plan as to how we go about reaching those goals. We're going to go and we're going to get quotes from different insurance companies, okay, to find out what the deductibles are going to be, what the premiums are going to look like, how expensive are these policies going to cost me? Okay, how much money are these policies going to cost me? And then step 3, we put it into action. We purchase the policy, okay? And if in the event we do have a loss, okay, we will have the opportunity to work with the insurance company. Hence step 4, check your results, right? See how easy they are to work with. How difficult did they make the process, or how easy did they make the process? Okay, so companies like, Geico or Erie Insurance. Erie Insurance is actually a great insurance company. It's out of Erie, Pennsylvania. Okay, but they're a great insurance company to work with. Their customer service is phenomenal. Okay, so that checking your results component is also about, all right, I had this unfortunate thing happen to me. Right? How easy did the insurance company make it for me to get back to being whole again? Okay. And then again, it's all about a cyclical process going through your own personal planning for your insurance program. And this will change and evolve the older that you get. Okay. So, in your early 20s, there's not a lot of things that you need to necessarily insure against other than renter's insurance and vehicle insurance. If you get older and you get married and you start to think about having kids, and then you get a home, then there are other insurance policies that you definitely need to consider as you move through the different life stages approaching into your retirement. Which leads us into property and liability insurance. Okay, so when we think about property and liability insurance, this is probably the single largest insurance component within the insurance market here in the United States. Okay. So many major disasters occur every single year that create catastrophic amounts of property loss within the United States. Okay. And if you think about it, just this year alone in the Gulf of Mexico and in the Atlantic, we've had more hurricanes, okay, this year than I think we've had in almost 50 years. Okay. So hurricanes this year have created a significant burden to the insurance companies. And in some states, like the state of Florida, companies like State Farm, Allstate, Geico, they don't even sell property insurance anymore. Okay. You have to purchase your property insurance through the state of Florida. Okay, and they did that because the hurricanes that came through, um, Hurricane Andrew, Katrina, when it went up into Louisiana, which still impacted Florida, have created over the years so much damage that the insurance companies said, we're just simply not going to insure um, property in these high risk areas. Okay. So the main risks that relate to our home and the automobile, okay, that we drive, the main risks that we face, okay, are property damage, okay, and in the case of our vehicles, all right, the injuries that might be sustained by other people and their property in the event, okay, that we cause the damage, okay, that we're found um, liable for the accident. Okay. So what are some of the potential property losses that we're talking about here? Well, obviously our homes, right? Fires, hurricanes, tornadoes. So our homes, our automobiles, other things within our house. So we have, the physical structure. That's what we're talking about when we talk about the home. Okay? Furniture, clothing, jewelry, my Peloton, my tri-bike, all of my camping gear. Okay, so all of your other personal property are considered to be part of your potential losses. And we have the risk associated with physical damage. Okay, this is the damage to the home itself. So caused by the hazards that we were talking about, okay, or the perils, okay, more appropriately, fire, wind, water, and smoke. And we also have the destruction of property or the temporary loss of use. Okay, if something happens to our home, we can't live in our home until it has been repaired, then we have to go find another place to live for that period of time. Okay, and some insurance policies will have provisions within the policies themselves to pay for a portion of and up to a certain point a place for you to live while the repairs are being made. And then we have risk that is also associated with loss of use. Okay, something gets stolen. Okay, we can no longer use it. Our car gets stolen, right? Or vandalized, and it has to get repaired. We lose the use of that vehicle for a period of time, but we still have jobs to get to. Okay, so we suffer the loss not only of the vehicle, but we suffer a financial loss associated with having to pay for a rental car for that period of time, okay, which the insurance company then pays us back for. So how do we go about protecting against these potential liabilities? Well, we purchase what's called liability insurance, right? And a liability, right, is the legal responsibility that we would have, okay, associated with the financial cost of another person's losses or injuries. Okay, if you get into a car accident and you are deemed to be at fault, okay, and the person in the other vehicle, right, suffers a broken arm and they incur medical expenses, okay, you are liable for those expenses. Okay, so it's a legal responsibility. Okay. And we have what's called negligence, right, which is the failure to take ordinary and responsible care. Okay. And this is a sad but true example, failure to supervise children at a pool. Okay, if you have a pool, okay, and you have children that are coming over to play with your kids or that you are possibly babysitting, okay, you have a duty, okay, to provide responsible, ordinary, and reasonable care for those children. Okay, and if something were to happen to one of those children, God forbid, okay, we're talking about negligence. Okay, you failed to take ordinary or reasonable care of that child. Then we have what's called strict liability, right? Where a person can be held responsible for either intentional or unintentional actions. Okay, I think you can come up with a couple of good examples there. And then lastly, we have what's called vicarious liability, right? And this tends to be more related to a parent-child relationship, okay, where the parent is held responsible for the actions of the child. Okay, so vicarious liability exists when one person is held responsible for the actions of another person. Okay, there was a case, a legal case in the state of Texas, okay, where a very wealthy family, their son had gone out drinking, and he was underage, and he wound up getting into a car accident and killing the girl in the other vehicle. And when the case went to court, the mother of this child, the boy who wound up killing the girl in the other vehicle, the mother was actually found guilty as well of vicarious liability because she had failed in her duties, okay, to raise her son in such a way that he would understand the difference between right and wrong as it came to drinking and then drinking and driving. Okay, so that was a case, I think it was a couple of years back. All right, and they had some, the media had some special name for this particular case, but nonetheless, vicarious liability is very real. Okay, and lastly, the third bullet point, more applicable to what you're going to face when you leave the university, is an employer can be held responsible for an employee that causes damage. Okay, it's very important depending upon the line of work that you're going to go into. Okay, so our third objective is we're going to start getting into home and property insurance, what the differences are between the two. Okay, what's available to you as a potential homeowner and you as the renter of a property that somebody else owns. So when we think about homeowner insurance coverages, okay, we're talking about the physical structure itself, okay, the home, and other structures that might exist surrounding the residence. Okay, so we're talking about the damage to your home, your tool sheds, your pagodas, your gazebos, trees that you might have planted, the nice landscaping that you put in. Okay, so the homeowner's insurance will cover those types of items. Additional living expenses. Okay, if you guys think about it, right? If your home burns to the ground and you have to eat out every single night, right? You're going to incur additional living expenses that were not part of your life prior simply because of the loss of your home. So insurance policies have provisions to cover the extra costs associated with not being in your home. We also have coverages that apply directly to the personal property that are physically in your home or while you're traveling. Okay, so if you have something that gets stolen that you took with you while you made that trip to Europe, all right, after graduation, all right, then we have personal property provisions within our coverages that would kick in. So we have what's called a personal property floater, okay, which deals more specifically with high value items, okay, that you physically have to itemize, okay, like whatever, my triathlon bike is worth X, my camping gear is worth Y. I have one single piece of jewelry that's worth Z, but high value items typically have to be itemized within the household inventory. So if you have items in your possession that are of significant value, okay, then it's important to go through and itemize and put those items into a household inventory, okay? When I say household inventory, I'm not just talking about writing it down on a piece of paper, talking about going into Word, typing in the name of the item, when you purchased it, what the purchase price was, where you bought it, okay, taking a picture of it, putting the picture into that Word document, printing it out, and saving it to the cloud. Okay, that way you've got a physical document that shows what it was, and you also have a backup of the itemization in the cloud. We have medical payments, okay, medical payments coverage provisions within our insurance policies for, minor accidental injuries that might occur on your property. Those injuries could have been caused by you or family members or pets. Say you have a pet that I don't know, bites a neighbor who came over to knock on your front door. Okay, there are provisions within your homeowner's policies that would allow for coverage to pay the medical bills for the neighbor who suffered damages as a result of your pet. Okay. So most homeowners policies will provide some basic personal liability coverage up to about $100,000. But you can, insurance, they'll sell you more. Obviously, they'll sell you whatever you'd like up to certain points. You'll pay for it in terms of the premium. All right, so that's something that you have to evaluate when you're setting your insurance goals. Right, but nonetheless, you can pretty much get whatever coverage you'd like for a fee. And then finally, we have a very important policy that every one of us should have. Okay, and it's called an umbrella policy. And then we also refer to it as a personal catastrophe policy. Okay, that goes above and beyond the basic personal liability coverage that you're going to get within the basic homeowners policies that you're going to be looking at. Okay, and typically this policy would kick in once all the other policies have exhausted themselves. All right, so it's very, very rare that this would ever get used, which is also why it's not very expensive. Okay, so you can get $1 million insurance policy, an umbrella policy, for relatively cheap. Okay, probably for $10 a month through companies like Liberty Mutual or Progressive. Typically, you have to have your insurance policies and renters policies or homeowners policies with them as well to get access to an umbrella. But you can do it. Okay, and it's just a backstop. Okay, it's the God forbid the shit hits the fan and I run out of insurance and I've got nothing left. I have this backstop, this umbrella policy that will kick in to help cover the remaining components of the situation. But again, if it gets to this point, all right, that's why we call it the personal catastrophe policy. Because if it gets to this point where this policy actually gets, enacted, then something really, really, really catastrophic had to happen. Okay, but it's cheap. You can usually bundle it with what you've already got. And I strongly recommend everyone looking at getting an umbrella policy. We have other specialized coverages. Okay, so homeowners insurance. Okay, it used to, but it does not anymore. Within the last 15 years, I would say, these homeowners policies are not going to cover things related to floods, earthquakes, hurricanes, tornadoes, right? They have other programs that you can gain access to policies from, like the National Flood Insurance Program. You can get insurance coverage for earthquake damages as it relates to an endorsement onto your homeowner's policy. But the basic policies themselves, as they're written without endorsements, are generally this day and age not covering the losses associated from floods, earthquakes, other accidents. So renters insurance, right? This is important for you guys because most of you are probably renting when you're back on campus. Okay, please God, let it be next semester, right? So renters insurance is the protection that you receive against the financial loss due to damage or loss of your personal property. Okay. If the apartment that you're living in, okay, suffers fire damage, okay, and your particular apartment is impacted by that damage, you've suffered a financial loss because of that damage. You can't live there. Your television burned up while it was on the wall. You've suffered losses. Okay, so your renter's insurance helps protect against those losses. The owner of the building, the homeowner, the landowner, they have their own insurance for the structures. Okay, your renter's insurance covers your property on the inside of what they own. Okay, so the building owner's insurance, more often than not, okay, doesn't cover your personal property. You as the renter have to take care of them. Okay, and it's not super expensive. Okay, it's not super expensive. And living on campus, even in dorm rooms, okay, you can buy renter's insurance through the university for the personal property within your dorm room. Okay, because if you don't have it and something catastrophic happens, a pipe bursts, okay, and floods your entire dorm room, okay, and you don't have renter's insurance, okay, you're on the hook for replacing that $2,000 Mac laptop, okay, as opposed to the insurance policy replacing, okay, and those types of policies are super inexpensive, right? So I strongly recommend that if you're on campus or off campus, whatever you're doing, if you're renting, get renter's insurance, because only about 40% of the folks who are out there renting even bother to get insurance. Okay, it's cheap and it will save your rear end, okay, in the event that something bad does happen. Okay, so just go out and get it. Maybe it might cost you $100 a year, okay, for renter's insurance, right? So it's not expensive, but the expense on the other side, if something were to happen, is a lot greater than $100 or $120 a year. And there's multiple different types of policy, okay? And you can go through the text and read about the differences between all of these, all right? But you need to understand that we've got different forms called HO3, homeowners 3, which covers all risks. We have a tenants form, HO4, comprehensive form, HO5, condo forms, HO6, country home form, HO7, okay? But just nonetheless, you understand that depending upon the type of residence that you're renting and where that residence is located, okay, then you'll be subject to certain types of policy forms. Okay? The most common two, okay, are going to be the tenants form, HO4, and the comprehensive form, HO5. Right? So when we think about cost, right, because this is important, right? Everything comes for a cost. The insurance companies, right, want you to pay them more money. So what factors influence the amount of coverage and the cost of insurance? What we want to do is make sure we're looking for policies, okay, that come with what we call full coverage, okay, rather than a co-insurance clause where we're stuck with having to pay for a part of the loss. Okay, so think about it like this. Okay, you have two policies. Okay, each policy has $100,000 worth of property structure coverage, and your property burns to the ground. So you've suffered a $100,000 loss. Okay. A full coverage policy, right, cuts you a check for $100,000. Okay, you lost $100,000 worth of property. The clause within your policy document covers up to $100,000. They write you a check for $100,000. On the other hand, you have a co-insurance clause within your policy, okay, where you're on the hook for 20% of the losses and the insurance company will cover the remaining 80%. Okay, so instead of getting a check for $100,000, now you're on the hook out of your own pocket for $20,000 of the loss. Okay, and the insurance company only now writes you a check for $80,000. Okay? So we want to have policies from a home insurance perspective with full insurance clauses as opposed to co-insurance clauses, because that puts the insurance company on the hook for the full amount of the loss. And then we get into, well, how does the insurance company go about calculating the value of the loss? Okay, and there's two different ways that they're going to look at it. Okay, they're going to look at it either from an actual cash value standpoint, okay, or replacement value standpoint. Okay. So when we think about the actual cash value, all right, what you receive from the insurance company is based upon what that item would cost from a replacement standpoint, less depreciation. Okay? So if you bought the house 10 years ago, or you bought the car 10 years ago and something were to happen, okay, the insurance company would look at how much is it going to cost to actually replace that vehicle today? And what would the accumulation of depreciation have been for the car that you had owned? Okay, and they will give you a check for the difference. So they're going to give you a check for the actual cash value of the loss. Or the second settlement method is replacement value. Okay, and replacement value, we don't consider depreciation. We simply consider what does it cost to replace this item today. And there could be some limitations, okay, on what the replacement cost looks like. In this example here, it just says could limit the replacement cost of the item to 400% of the actual cash value. So they relate their limits to a depreciation accounted for settlement method. But replacement value policies on average tend to be about 10 to 20% more costly than actual cash value coverage. Makes sense, right? You're asking the insurance company to pay you for what that item costs today and forget the depreciation factor. I don't care what depreciation is. I still have to go out and buy that new television or buy that new car today. Okay, so I don't care about depreciation as the policy holder. Okay, but those policies come with a higher premium because the insurance company knows they're going to be on the hook for a larger amount of money when and if that policy gets turned on. Okay, so we've got different factors, right, that go into determining how much coverage that we need. What's the replacement value of our home? What's the value of the contents within our home? How much liability coverage do we desire? Okay, and then do we have other things within our home that need specific coverage? Okay, jewelry, fur coats, cameras, silverware. Cameras is a big one. Cameras is a really big one. Okay, most folks don't really know that cameras can be fairly valuable between the actual body of the camera and the lenses that come along with the cameras. I mean, sometimes you could be talking $10, $15, $20,000 of value in total for the different pieces of your camera equipment setup. Okay, so always important to get those items specifically covered. Okay, you know, where our home is located. Okay, whether it's in the city or in the woods somewhere. Okay, whether it's in a floodplain or in the general paths of tornadoes, all of those things factor into the cost of our premium. Okay. What's our home built out of, right? Is it made out of brick? Or is it made out of wood, right? One is less costly than the other, right? What kind of deductible do we have? Okay, the higher our deductible, the lower our premium. The more that we're willing to pay out of our pocket first, okay, the lower our premium, because it's less money that the insurance company is eventually going to have to pay. So how do we go about reducing the possible cost of these home insurance premiums? Well, there are certain things that we can do to reduce risk. We have alarm systems, we have smoke detectors, we have carbon monoxide detectors, we have fire extinguishers in the house, right? We can get Multi-line discounts. Okay, if we have our car insurance with our homeowners / renters insurance with our umbrella, and it's all with the same company, like Geico and Liberty Mutual are essentially the same company, okay, we'll get multi-line discounts that can be fairly sizable. Right? So when we're doing our research, it's very important that we go out and we investigate. Okay, we investigate what the costs are for the coverages that we're looking to obtain. Okay? And then this is really important: service, customer service. All right. If something happens that you have to enact the provisions within the policy, and remembering that insurance policies are designed to for loss only scenarios, not gains. So if you're turning your policy on, it means you suffered a loss, right? And generally speaking, that's not a good thing, right? It's very important that you work with an insurance company that has good customer service, because the last thing that you need to be doing while you're dealing with the impacts of a hurricane knocking down your house, the last thing you need to worry about is your insurance company giving you a bunch of crap or making you jump through hoops. Okay, so customer service is extremely important when you're doing your research for insurance companies that provide renters insurance and vehicle insurance. Okay, so check the customer satisfaction reports using consumer reports. Consider how the claims are settled, the different settlement methods, whether it's the actual cash value or replacement value. Right? Very, very, very important to do. Okay. All right. So automobile insurance. Okay, this is definitely, so renter's insurance, something you need to pay attention to. Automobile insurance, right now, I would say most of you, your parents are still being quite generous and are helping cover your automobile insurance. But at some point, right, that spigot gets turned off, right, and you're on the hook. Right? So the first thing we have to understand is that you have to know that whatever state you're going to be living in, they all have different rules and regulations around the types of coverage that you're required to have. Okay? So financial responsibility law. I would say now every state, right, has what's called compulsory automobile insurance law. It means that you have to have vehicle insurance. You're required to have some minimum level of insurance on your vehicle. Okay, and requires drivers to prove their ability to cover the cost of damage or injury caused by them in an automobile accident. Okay, you have to prove that you have the means to cover the cost of damage or injury. Okay? And when we talk about the types of injury that might occur, we're talking about two different categories of coverage. The type of coverage that will deal with bodily injury and the type of coverage that deals with property damage. Okay, two different categories of coverage there, right? Which is why when we talk about the three different components of coverage, it's broken down into three different numbers. Okay, two of which relate specifically to bodily injury and one of which that relates to property damage. Okay, so in this case, and you may have seen this on your own insurance policies, and I would encourage you to find it. Go ask your parents. You want to see the policy that they have, okay, for your car, right? And it'll look something like this: 100, 350, probably in your case 100, 300, 100, could be 300, 300, 300. The more coverage you have, the more expensive the premium, right? But nonetheless, the first two numbers relate specifically to bodily injury, and the third relates to property. Okay? So when we think about bodily injury, okay, the first number, 100, right, is saying that there's a $100,000 limit, okay, that will be paid to one person in an accident. Okay, that's the maximum that gets paid to one individual in an accident. Okay. The second component is that the 300 is saying that there's, in addition to the $100,000 limit maximum for one person in an accident, now we have a maximum overall limit. Okay, so there's a $300,000 limit that will be paid to all persons within an accident. Okay, so if there are multiple people in the vehicle, okay, then the maximum amount that would get paid out is $300,000. That's the limit. Okay. If it goes above and beyond that, it doesn't mean you're not liable for that. It just means the insurance policy won't cover it. Okay, but hopefully you picked up that umbrella policy, all right, to help cover some of those extra expenses if above and beyond the 300. So we have bodily injury, maximum amount payable to one individual, and then maximum amount payable in total to all persons in the accident. Okay, so 100, 300. And then we have the third component, the 50. And this relates specifically to property damage. Okay, so we have a $50,000 limit that the insurance company would pay out for the damage to other people's property. Okay, mailboxes, fence posts, the physical property itself, the homes, the vehicle that was involved in the accident. Okay, so the physical damage to the property has its own coverage. So we call this a 100, 350 policy. Okay, my guess is that your policies are going to be either a 100, 300, 100 or a 300, 300, 100. Okay, those are fairly common policy limits these days. And a lot of times, if you want to get that umbrella policy, all right, the insurance company will require you to up your coverages, okay, on your vehicle and on your home, okay, in order to get access to that umbrella policy. It's usually not that much more expensive, but they usually do require you to bump up your coverage. Okay. All right, so we talk about bodily injury liability. This is covering the risk that's associated with the financial loss due to whatever legal expenses that come in from the accident, medical expenses if they're injured, wages that they lost because they can't go to work because they're in the hospital. Okay, and then you've got other expenses that might be associated with the injuries. Okay, chiropractor, physical therapy, okay, that you were responsible for. And medical payments coverage. This covers the cost of healthcare for the people injured in your automobile, okay, including yourself. It also covers if you're injured while riding in another person's vehicle and that person's car gets damaged. Okay, so medical payments coverage is also important. Uninsured motorist protection. Okay, again, additional bodily injury coverage that you can have applicable to your vehicle policy. If you get injured, okay, by a vehicle that doesn't have insurance, okay, you have uninsured motorist protection. Okay? But that doesn't cover the property damage. It only covers the cost of injuries to you or your family if you get hit by a person who doesn't have insurance. Okay? And then we have something that's called no-fault insurance, where it's designed, to provide, a fast method for paying for damages without taking any legal action. Okay, where the drivers will just simply collect from their own insurance companies. One person admits fault, okay, the insurance companies get contacted by the respective parties, okay, and then the at-fault driver is on the hook for the expenses associated with the no-fault driver, okay, and the no-fault driver's insurance company subrogates against the at-fault driver's insurance company, and they work it out through the back office to pay for the damages associated with the no-fault drivers to the no-fault driver's vehicle. Okay, so just doesn't involve the legal system. So a nicer way of doing it. It's the preferred way of doing it. Okay, property damage liability. Again, we talked about this, covers damage to the other person's car when you're the one at fault. and other things, street signs, buildings, whatever might happen. Okay. Collision insurance, right? When you're involved in the accident, the coverage will pay for the damage to your vehicle regardless of who is at fault. Okay, if you're not at fault, the insurer will go and try to collect from the other driver's property damage liability first, which I just said that word, subrogation, that's what we call that. So they'll try to collect from the at-fault driver's insurance company, which usually happens in 99% of the cases. Okay. And then the coverage that you receive is essentially limited to the actual cash value of the vehicle based upon an appraisal service. Okay. So not going out and replacing it at current market prices, but what was the value of your vehicle in the market at the time of the accident. Okay, think of it as going to whatever CarMax and getting a quote for the value of your vehicle, because the value of the vehicle at CarMax or Cars.com or Edmunds or wherever, it obviously takes into account depreciation, okay, on the vehicle, because what it's worth today is not what it was worth 5 years ago, and so the market value essentially becomes the actual cash value of the car. All right, then we have what's called comprehensive physical damage. All right, so this is damage to your vehicle that's not caused by the collision. All right, your car catches on fire, your car is stolen, somebody breaks your windows, right? Hail, that's a big one. Hail puts little golf ball size dents in the hood of your car, right? These are all things that are covered under the comprehensive component of your insurance coverage. Okay. Falling objects, okay? A meteor, all right, hits your vehicle, okay? Covered under the comprehensive physical damage clause within the policy. Okay, deductibles. This is really important, okay, because this is something that you're going to have to consider, before you go and file a claim. Because if you file claims, there are some companies like Allstate does it. I think Progressive does it. Geico may do it, where they guarantee that your claim's not going to go up if you only have one, if you've only made one claim, over a rolling 3-year period of time or something. All right. So, but nonetheless, it's important that you kind of put filing a claim in context with what the overall cost of the claim is going to look like. Okay, so in this example, we're talking about a broken windshield. If you've had a broken windshield, okay, and you've gone out to get an estimate for what that's going to cost, so $250 to replace it, okay, and you have a $100 deductible for your comprehensive coverage, okay, it means that you pay the first $100, okay, and the insurance company will pick up the difference. So you pay $100, the insurance company pays $150. Okay. So from a myopic point of view, all right, that's great. You only have to pay for $100 of the $250 expense. But if you file that claim with the insurance company, okay, you're going on record filing that claim, holding the insurance company accountable for paying you $150. Okay. As compared to using your insurance for kind of what it's intended to be used for, which is the larger, more catastrophic type scenarios. So let's say you replace your windshield, right? So that's your one freebie, right? That's your one claim that doesn't impact your premium. And it's only talking about $150 of extra money that would have been had to have been paid out of your pocket. Okay. And then 2 days later, you're out driving and you get into an accident and you're at fault for that. Okay. More catastrophic than a windshield breaking. Okay. Your insurance premium is going to go up drastically because you've already used your freebie, and the damages involved with your vehicle accident are significantly greater than a $250 windshield replacement. So the point here is that just because you have insurance, okay, doesn't mean you should always be using it for every single instance that might be covered. Okay, you need to consider the impact on your premiums for when you file that claim. Okay, use the insurance for what it's intended to be used for, right? And that will help keep your premiums down. Okay. Other insurance coverages, wage loss insurance. Okay, if you have this provision, okay, within your policy, they'll cover any losses due to the accident based upon your lost wages. Towing and emergency road service. This is one that I just is irritating to me because they add it on without even asking you about it, you know. And if you've already got AAA, you're doubling down, and so it's usually just an added expense that you don't necessarily need. So, point here is that make sure you read all the different provisions that you're paying for within the policies that you're looking at getting. And if you don't like some of the provisions, just call the insurance company and tell them to take it off. You don't want the towing emergency road service? Tell them to take it off. They'll take it off. You don't want the wage loss insurance because you've already got another insurance policy that would kick in? Tell them to take it off, right? There's no point in doubling down on a lot of these insurances. So what are some of the things that impact automobile costs? Okay. How much coverage, okay, that 100, 350 that we talked about, right? The amount of coverage, okay, will impact your premium. And then because you do have, you know, if you're in an accident and you're going to be turning some of these provisions on, especially the bodily injury provisions, there's probably a high likelihood that there's going to be some lawyers involved. Okay, so there's some legal concerns that you need to think about, right? Which is why from a starting point standpoint, we will always typically recommend that 100, 300 as a starting point, okay? For me personally, because I've got 3 children and 2 dogs that usually travel with us, okay? And I've got, you know, a Subaru Ascent, right? My coverage is 300, 300. Okay? Actually, no, it's not. I just changed it to 300, 500, okay? And then the umbrella policy on top of that, okay? I can't stress that enough. Okay, the most expensive part of this equation here is going to be your base coverage, 100, 300. Okay, tacking on an additional $1 million is only going to cost you an extra 100 to 120 bucks a year, most likely. Okay, but the added peace of mind that you have from having this $1 million umbrella policy goes a long way. So legal concerns, what are some of them? All right, every state has the laws that do require some sort of liability insurance coverage. And the reason why they do that is because most folks simply don't have the ability to cover expensive court settlements with their own personal assets. So we buy insurance, okay, in order to offset what we have to use of our own. The amount of coverage has increased over time because the price of cars has gone up significantly over time. Okay. So typically now for the property liability, even though the minimum recommended is 50, I strongly recommend 100, simply because things have just increased in value over time, and 50 is generally on the edge of not being quite enough. Okay, so when we talk about those 3 numbers, my recommendation to start with, okay, at your age would be a 100, 300, 100 policy. Okay, and then as your situation changes, as you move through those different life stages, it's something that you definitely want to consider when you begin to add more people to your home. Okay, or you move into a higher risk area for your job. All right. So some of the things that influence the insurance premiums on vehicles, okay, the type of car you have, right? It's more expensive to replace a BMW than it is a Honda Civic. Okay, so the year, the make, the model, okay, how frequently are these vehicles typically stolen, right? So I think last year the most stolen vehicle was maybe a Toyota Camry. Okay, so the theft rate for your vehicle factors into the premium that you pay. The color of your car factors into the premium that you pay. Okay, if you have a bright yellow or bright red, candy apple red Corvette, all right, you're going to pay more money. If you have that beautiful diamond pearl paint finish on your Chevy Tahoe, you're going to pay more because it's going to cost more money to repaint that vehicle if it's ever needed to be repainted. Okay, rating territory. Okay? Where you live plays a role in your premium. If you live in high risk areas, whether that's from a weather standpoint or from a theft standpoint, okay? If you live in the city versus in the suburbs or in rural areas, okay, plays a factor into your premium. Driver classification is very important. How old we are, okay? Whether we're men or women. And sorry guys, but the ladies beat us here. Their insurance premiums, ceteris paribus, are lower because statistically, over time, okay, women are better drivers. All right, just a fact. Sorry, stating facts here. All right, marital status. You're married versus single. Why is that? Well, insurance companies, based upon all of their historical information, have said that married individuals tend to be lower risk than not. Okay, and then when you combine age with marital status, you get a different story, right? Young single folks have a tendency to be higher risk than older married people. Why? Because us old farts don't go out on Friday nights. Okay, we're not out till 2 o'clock in the morning on Thursday evenings. All right, we're at home in bed at 9 p.m. Right, so during the periods of time during the day where, let's just say, more risky driving behavior takes place, the older married individuals are at home avoiding the risk. Okay? So it does factor into your premiums. Okay? And then if you're unable to obtain insurance, what happens is you get dropped into just like this assigned risk pool. You fill out this questionnaire, and then all of a sudden you just get dropped into a bucket, and then your premium gets spit out on the other end. Okay, so how do we go about reducing the premiums that we pay? Well, it's important to compare companies, right? The vehicle insurance business is highly competitive. And when you think about bundling vehicle insurance with renter's insurance with an umbrella policy, it becomes extremely competitive, right? So Progressive, Geico, Erie, Allstate, all right, all great companies in their own right. Okay, so go and compare these entities against one another using NetQuote, great website. Okay, you can compare them right there online, right? But in order to really think about how do we lower our premiums, okay? First and foremost, just be safe. Okay, reduce your risk, avoid your risk. Okay, just keep a safe driving record, avoid accidents and traffic violations, have security devices, be willing to accept a higher deductible, especially if you're driving a more expensive car, right? Paint gets scratched on your BMW, you can pretty much bet that it's just going to be $1,000 right out of your pocket immediately because it's an expensive car to repaint. Okay, so higher deductibles equals lower premiums. Okay, but it has to be in balance with your financial situation. So if you live in a high risk area and you carry $1,000 deductible, you're on the hook for the first $1,000 for each claim that you file. Okay, so maybe a $500 deductible might be better for you depending upon your personal circumstance. Okay, don't smoke, all right? And then get that multi-line discount. Okay, combine your vehicle insurance with your renter's insurance, with the umbrella policy, with the same company, and your premiums across the board will be less. Pure and simple. Okay, plain and simple. All right. Okay, so that takes us to the end of our chat regarding homeowners, renters, and motor vehicle insurance. Okay. We will pick up with our next lecture on health insurance. Okay, this is a big one. Okay, and unfortunately, it's quite confusing. Okay, especially when you get that first welcome packet from your first employer after you graduate. You're going to be faced with some decisions that we're going to talk about in our next lecture. Okay. Have a great rest of the day. Talk soon.